Some of the best quality loans that you'll be able to get for any small business are generally those that are backed by the SBA. There are programs available by the SBA for things like an express loan that actually are focused more on the personal credit of the borrower relative to the business itself. Some lenders will just do a credit check on the borrower and not even look at the business and will finance a loan up to say 150K. All SBA loans come with a major hitch, which is a personal guarantee. But if you're comparing that to paying 60 or 70% interest for some sort of merchant cash advance, as long as you feel strongly about the size of leverage and the quality of cash flows, then it can be a really good option.
You're listening to Ecom Finance Experts by Finaloop, where we dive into e-commerce finance best practices with the sharpest minds in the game. I'm joined here today by Gabe Andres, the founder of Lodestar and a fractional CFO. How's it going, Gabe?
Good. Thanks, Jacob. Pleasure to be here. Thank you for having me.
Yeah, sure. So we've done some content together in the past a while ago, and I thought it was really great and get some good insights into the market, finance, etc. So happy to have you back here again today, and I think we're going to dive straight in. So now you're a fractional CFO. You see lots of different kinds of businesses. When the average person comes to your office or hops on a call with you, what would you say are the main recurring issues that you see that can be fixed within a P&L or a balance sheet?
Yeah, it's a good question. So, generally, new clients will reach out to me, and most commonly they don't have really strong accounting practices in place from the outset. There's often a pretty cumbersome and detailed sort of cleanup or catch up bookkeeping exercise that needs to be done before we can really dive in and get any real insights into their books. So that can often be a challenge. And then when we do and eventually do that exercise, we'll go through their P&L and identify some of the sort of key cost centers, benchmarking those against sort of peers in the space and industry norms, and trying to identify really where there's areas of sort of relative strength or weakness that could represent opportunities for their business. So those are some of the kind of first things that we'll do, and often it can point to sort of just areas where we'll need to address and focus more attention as we're trying to sort of build out a plan or budget or framework for operating their business and a strategy.
When does the average customer/client come to you? Like, what is the revenue of a typical person approaching you?
Generally, you'll find that most, e-commerce brands, who is primarily who I work with, will sort of have a bit of a go it alone strategy for the first 2 years of operations until they get to, and obviously depending on growth, but they'll probably reach the sort of like 1.5 million or sort of just above $1 million range in revenue, where complexity starts to add up. They start to lose sight of sort of important cost centers in their business, in particular things like product costs, which can be which can be pretty difficult to track competently unless you have the right systems in place. And then they'll reach out to me with coming to me thinking, okay, yeah, I kind of totally lost a grip on my financials. The cash-based bookkeeping that I have isn't working anymore. I don't know what my profitability looks like. And that's where, there's this sort of overhaul and cleanup exercise that will get in there and help them with, so that we can try and prepare them for scale and help drive clarity in their finances.
Right. And until that point, most of them are kind of like DIY bookkeeping or...
Oh, no. So I don't think they're necessarily DIY. I think that they're, in most cases, they will have engaged a bookkeeper, certainly by the time they get to sort of $1 million in top line. I think that commonly you see a DIY approach until they can. I always kind of recommend to clients that a bookkeeper should be one of the first hires you make. If e-commerce brands, Finaloop's introductory plans that represent like a pretty amazing value proposition. So that's kind of a no-brainer. But you'll see that businesses will work with smaller bookkeeping firms that will help them just keep track of things. But often the more affordable price points come with just things like simple cash-based accounting, no understanding of channel level profitability or actual sort of product margins. As you know, these things are notoriously difficult to keep track of if you're just categorizing cash flows as they hit the bank feed. So
Right, definitely. And in general, like if you are looking specifically, let's say, at the gross margin of this particular client's P&L, and you see that, in this industry, the gross margin should be approximately, let's say, 60%, and this person is below the median. So what cost, and assuming, they're everything above that is assuming there's some kind of issue above the gross margin line, where would you usually dig in, and what would kind of issues be that might be driving lower than industry level gross margin?
So there's plenty that goes on above the gross margin level. The kind of some of the bigger cost drivers that I like to dig into first. I like to sort of break down the P&L above that level as sort of the net sales line, the kind of product profit line, which is sort of net sales less product costs, and then the gross profit line. And the really like the main cost centers that sit in between each of those layers are discounts. Right. So, that doesn't necessarily, that one's a tricky one because it can, not necessarily, it can drive gross margins, but can sort of be hidden in the detail sometimes just because of the way that it's accounted for. But also, just really critical to look at in detail and understand sort of how brands are thinking about pricing strategy, also the quality of the products, if they're needing to like discount significantly year round to really drive any momentum in sales, and it's a bit of a red flag.
Right.
So that's probably the first one I look at. The second is, is product costs and product margin in particular. And so often, when you depending on how they're treating that, you'll sort of those often actually, when you look at a new client, you see those costs are in their margins are actually inflated on a relative basis, because frequently you see that they're not capturing all of the kind of hidden costs in product costs and product margin that they maybe should be if they were looking at cost on a more like kind of pure landed basis. So that can often be a driver. So the last one, probably looking at gross profit, is the last main lever is really shipping and fulfillment. And so, we'll go in there and do an analysis of kind of, how like both where their shipping costs are looking at sort of like on a percentage of sales basis, but also add some context there in terms of like, how how that should apply in the context of their operations, like whether or not they're like doing a sort of pure drop shipping model, whether or not their fulfillment is sort of they're using like a centralized distribution sort of 3PL, or whether it's more distributed. So all that's context specific, but often can point to some areas of opportunity or insight.
Right. And do you give them like operational advice as well, or it's mainly financial analysis? Meaning, would you recommend them just, let's say, the specific 3PL?
So where I have the scope of my engagements can always be pretty broad, and broadly I like to think of myself as a partner to these to sort of brands and businesses, and will help them in any way that I can. If there's a good relationship that I have, and I do have relationships with certain suppliers in certain categories and 3PLs and other sort of often lots of software vendors and things like that. I'll make recommendations around some potential areas of optimization. I think that's like one of the really great advantages that I have as a fractional CFO, where I get to really sit in the kind of C-suite across several brands all at once and pick, hey, here's what's working well at one brand, here's what isn't working well at others, and cherry pick the best of all of these different companies and help cross-pollinate strategies. So I definitely try to do that to help drive value where I can. But I also think that often as an external partner and as a CFO, it's really important to be aware of acting as more of a support function and an advisor, as opposed to really trying to take the reins and force feed some approach that may just not be in line with the client's broader strategy or vision for the business. So what we do like to do up front with any engagement is sort of always start with building out like a really solid plan for the long term. Like where are we trying to drive the business? What are the key priorities and strategic initiatives that need to be hit? So that getting that sort of established from the outset can really help align both where I know that I can help drive value and help with the business. In many cases, the operations part is a really sort of tight knit, well-oiled machine already, but they might be struggling in other areas like financing, or sort of product development, things like that. So,
right. And regarding financing, do you see a lot of brands who have? I mean, everyone knows ecom is difficult, and you have the peak seasons, and you need to finance your next inventory purchase and BFCMs and all year round. So I assume you see quite a few brands that need help with debt financing and managing their cash flow.
Oh yeah. No, this is a big one. As you say, it's a seasonal business. It's also a heavily capital intensive business, and those two things don't really play nicely together. And what that means is like wild swings in cash flow and high cash flow variability. So, in low season, that means that there may be a necessary cash drain. And, for example, some of my clients, I can think of 3, in fact, that do in excess of 70% of their annual earnings in one quarter, in Q4. And they effectively just have to they have to think strategically about their profitability and cash flow on an annualized basis to fund the kind of cash shortfall through Qs 1 through 3 from this from this sort of single profitable quarter. So it's a real challenge for businesses, and unfortunately, not that I would name any names, but you do see what I think are a lot of probably targeted and not the best lending practices in the business, or just certain lenders that will target aggressively e-commerce founders that are already strapped for cash, need working capital to help them grow, but will come and market them with like really egregious financing terms that are often masked as because they might be some sort of like merchant cash advance, masked as like, hey, this is like 7% money, but if you look at it on an annualized percentage rate, you might be paying down that loan over 2 months, and you're paying like a 40% interest rate. So you see a lot of that stuff, and I think that that's where we've tried to provide a lot of counsel to founders around try and really minimize their cash conversion cycle so that they can reduce the reliance on external capital for financing inventory, but also just trying to source external capital from, ideally equity if they're overextended. That's not always possible. Equity markets have seemingly dried up recently for this business. And so if not that, then looking to sort of other external, better quality financiers that we have relationships with that can provide longer term stable capital, help them improve their business credit, and also have better rates and things like that. So
right. And would those kind of lenders provide financing for earlier stage companies that have $1, $2, $3 million revenue, or they need to be a little bit more advanced?
So there certainly are options available for those ranges. Some of the best quality loans that you'll be able to get for any small business are generally those that are backed by the SBA, and there are programs available by the SBA for things like an express loan that actually is focused. The loan assessment criteria are focused more on the personal credit of the of the borrower relative to the business itself. So they'll kind of like, some lenders will just do a credit check on on the borrower and not even look at the business, and you'll be able to and we'll finance a loan up to say 150K really quickly, really easily, and it'll be a simple loan with really attractive rates. Now, all SBA loans
with a personal guarantee.
exactly. This is what I'm going to say. All SBA loans come with a major hitch, which is a personal guarantee. But you know, obviously, if you're comparing that to sort of paying 60 or 70% interest for some sort of merchant cash advance, then as long as the size of leverage and the quality of you know cash flows are kind of you feel strongly about, then it can be a really good option.
You discussed both financing and shortening the cash conversion cycle. So do you get involved and kind of review contracts and try to see how to make payment terms more attractive in order to reduce the cycle, or is it mainly on the inventory side of holding inventory for less time, or both?
So it's, you know, I think all brands need to sort of be doing both, or not. Sorry, not in all cases. I mean, inventory strategy is a totally separate thing, and you know, I generally like to push brands towards more of like a just-in-time inventory sort of, and so inventory strategy and sort of supply chain. But it's not always appropriate, especially for certain products that have really long lead times, and it just adds a sort of element of risk around stockouts and things like that. So you know, it's an area. It's one reason why you do really need to have a really tight grip on your demand planning and demand forecasting, so that you can kind of get your inventory planning as close to the pin as possible and shorten the cash conversion cycle from an inventory planning perspective as best as possible. And that's an area certainly where we help a lot. You know, a lot of the focus of our forecast modeling is around, you know, granular SKU level forecasting, integrating historical data across all sales channels to develop like a granular inventory plan and forecast plan for sort of at the, you know, the product level across all sales channels, and then that helps really help with an integrated inventory management system. You know, you really have all the pieces of the puzzle that you need to really tighten the ship from an inventory planning and supply chain standpoint. So that's definitely an area where we help. The on the sort of, you know, payment terms side, I think that's, you know, more of an advisory role where we come in. We don't necessarily go in and help, you know, brands like to start negotiating with brand suppliers, say, oh no, like, you know, this has to be net 60 or we're not going to do business with you. Like that's not really our role. But what we do try to do is help educate founders and CEOs, you know, and COOs with what the goalposts should look like with regards to a cash conversion cycle and with regards to a finance, you know, in negotiating terms with suppliers, so that so they can kind of be armed with the right knowledge and the right data points to go into those discussions.
Right. It makes a lot of sense. You know where the goalposts are, and you know where the market is. You can definitely try to negotiate down and shorten your cycle. Where do you see, like, everyone's talking about tariffs, you know, the talk of the town, and no one knows where it's going. As of a couple of days ago, there were tariffs on Mexico and Canada. Maybe those have been postponed for a month. And China, yes, China, no China. But obviously, when you have very razor thin margins, and you know, market EBITDA is somewhere around 7-8%. There's not a lot of room left for maneuvering. So do you see people trying to plan and factor tariffs in, or move their supply chain around, or how have brands been thinking about tariffs in 2025?
Yeah, so you know, I work with brands that have significant exposure to the Mexican market. I work with brands that have significant exposure to the Chinese market. They're all really, you know, concerning trends with the new administration. You know, I'm not going to pretend to sort of sit here and be a geopolitical expert, but I think that from, you know, and no brand can really plan towards binary risk like that. So, you know, obviously what they can do is just control what's in their sort of scope, and what, you know, pull the levers that they can. And so where we're sort of trying to provide advice is around, where there is significant exposure, what other areas of our supply chain can we look to drive efficiencies? Because ultimately, when these tariffs come through, what you'll see is that most brands will end up passing those increased costs through to their customers. And I would, to your point, when margins are razor thin, you can't expect to like have a 10% increase in your product cost just completely wipe out your margin, right? So you have no choice really but to raise prices. But on a relative basis, if every brand is, if you think about the game theory, if every brand is doing the same thing, then all you need to do is go and find some other efficiency in your sort of product costs or your variable cost structure, so that you can you can outperform on a relative basis and still remain competitive. So
Hope that the demand doesn't go down too much if the prices go up.
hope that the demand doesn't go down. That's exactly right. But I guess the point there is that if everyone else is, if your key competitors in the market are forced to raise prices, as long as you can do, 1 percentage point better, then at least you'll still remain sort of a preferred vendor or supplier. And so, another sort of area that we're sort of exploring as well is that obviously tariffs are probably, it's the consumer that wears the brunt of the impact and the cost. They're also terrible for the foreign suppliers, as their business is completely dried up. So, we're also sort of thinking strategically about using it as an opportunity to renegotiate other terms that can, with those suppliers and say, hey, look, we know you're a lot of your business is drying up. We want to keep working with you, but our unit economics have totally changed. And so, what can we do about pricing? What can we do about terms? How can we, find a way to make this work?
All right, that's a good point. Just kind of bring this towards a wrap. One point we've kind of seen and also been reading a lot about it lately is, as opposed to the heyday of ecom in 2020, 2021, when growth was the name of the game and no one was really thinking about unit economics, kind of been seeing, and I was curious to hear if you've been seeing similar trends. Are some companies that are really, A, have good product market fit, and B, have really good economics, can doing very well, but there are quite unfortunately a few companies who are not. And if perhaps in the past either buying trends or external finance would have kind of pushed these brands forwards, now because the market isn't perhaps growing as much as it was, and because there's, like you said, the external equity has really dried up, a lot of these brands have not been doing too well. Have you been seeing that trend as well, kind of that split between those kind of brands?
Yeah, no, I definitely think so. To your point, there was kind of this glorious heyday that ended a few years ago, where brands were just able to spend more on marketing, and there was just kind of this this direct linear relationship with in terms of spend and sales, and it made it really easy to forecast. It made it really easy to budget, but the business just doesn't work like that anymore. And businesses, I find, have been able to adapt, and some new entrants that are that are sort of more agile and nimble from the start are able to compete, or the ones, the older ones that have already been around the block have been able to adapt their business, or they haven't, frankly. And I do see that, in this second category, there's a lot of pain being felt, to the point, to where they're not able to sort of like offsetting, deterioration in marketing efficiency and metrics by finding other areas for efficiency, either in their supply chain or in their or sort of operating leverage. There is tons of opportunity that has been, that you can drive today through, advancements in AI and software and tools and tech. And I do find that those brands that are sort of embracing those changes, shifting towards a leaner, lighter model, are the ones that seem to be thriving in this market. So, brands need to do what they can to be profitable. And if they don't, then they're going to pay the price. There's no real room for external financing to come in and fund, operating losses. So
Exactly. And you think most of the efficiencies, like AI efficiencies and software efficiencies, are on the OpEx side, or are they also product
yeah,
sales related?
no, I think they're mainly on the OpEx side. I think that they can drive efficiencies on the product side to the extent that like certain, inventory management systems or data analytics platforms can help drive insights and analysis and spot spot areas of sort of weakness or underperformance quickly on a relative basis. I think that those are, really great tools to be leveraging, and it's a real area of focus in our business, making sure that, our clients are always armed with the most timely and up to date information for decision making, and I think that's a really critical part. But no, to your point, obviously it's not like there's major advancements that are happening in sort of like product cost and innovation and things like that. So,
all right. Well, thank you very much, Gabe. It was a real pleasure. If anyone wants to find out more or reach out to you, what's the best way for them to do that?
Yeah, so appreciate the time here, Jacob. You can find me on LinkedIn. My name's Gabriel Andres, and also my website is lodestarcfo.com. So you can reach out to me via there, and obviously it would be great to connect with any and all e-commerce founders that are interested in catching up and talking about their business.
All right. Thank you so much.